Hi, I'm Kristen King, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. So, markets have rebounded sharply since the sell-off in March, largely thanks to a mixture of fiscal stimulus, government spending, tax cuts, benefit payments, and monetary stimulus. However, comments from Fed Chair Jay Powell have got investors starting to ask if the Fed has reached its limits. Powell said that many small to medium-sized businesses in the U.S. may need direct fiscal stimulus from the government after the Fed's Main Street Loans program came under scrutiny. Powell suggested that issuing grants might be appropriate, which put him at odds with the Treasury Secretary Steve Mnuchin, who is not in favor of more PPP funding. So, can Wall Street or Main Street expect any more help in 2020 into 2021? And why has that help been so important thus far? Well, the Nasdaq is up 44% over the last 6 months, and the S&P 500 is up 32%. Recent Bank of America research showed that since March, the Fed has bought $1.4 billion of assets every hour, and over the same period, the market cap of the Nasdaq has risen by $1.6 billion per hour. Correlation and causation aren't always the same thing, but you almost certainly have to draw a connection between these two astounding statistics. In other research, Bank of America found that the pace of central bank purchases has been falling and falling quickly, not just in the USA, but also in Europe, Japan, and the UK. What's more, the bank estimates that the pace of asset purchases will fall further into 2021 to settle at less than a quarter of their Q2 2020 peak. So it's possible that central banks have used up all their ammo, or are at least keeping their remaining powder dry against the possibility of a second wave of COVID-19. If so, what are the prospects of further government spending to support businesses and the economy? Well, Democrats in the House of Representatives were reported to be working on a new $2.2 trillion relief package this week. It's likely that this initiative will fail, especially as we head into a partisan Supreme Court debate and a bitterly contentious election. After all, with elections just a matter of weeks away, Republicans in Congress are unlikely to want to be seen as siding with their rivals. Republicans in the Senate, who have not been directly involved in the latest discussions, had proposed a far smaller program of just $1 trillion. It's also worth keeping in mind that earlier in the year, Democrats were accused by Republicans of shoehorning special interest provisions into the initial stimulus deal. President Trump is often unpredictable, so the White House response is a wild card, although it's thought that he'd want to put his distinct imprint on anything that passes. It's also possible that Democrats have stacked the proposed package in a way that guarantees Republicans will reject it, as this close to an election, any bailout could favor Trump. That aside, the U.S.'s debt to GDP ratio, that's the amount we owe versus the amount we generate, is expected to exceed 100% in 2020 under current spending plans for the first time since World War II. At current rates, that ratio is forecast to rise to 200% by 2050. Currently, rates are close to zero, so financing the national debt is not too onerous, but because of the scale, even a small rise in rates can lead to a huge increase in the cost of servicing these debts over future decades. Traders need to remember that 10-year bond yields were almost 300% higher than current rates just 1 year ago. They have to decide where the balance of probabilities lies between fresh fiscal stimulus or none at all, and how the markets would cope if no new help was forthcoming. Has the economy recovered sufficiently to support the relatively high earnings multiples major indices find themselves trading on? Or are U.S. equities priced for perfection here and potentially in line for a very rude awakening? Only time will tell. As always, make sure you do your own due diligence before making any investment decisions.